All right, Science Flipping podcast listeners, as always, this episode is brought to you by Rocketly.ai. If you're looking for a seller lead generating system that has automation, an AI bot, and has sellers coming to you, then Rocketly.ai is your choice. Make sure you head over to the website, fill out an application, and schedule a demo now to see the power of Rocketly.ai. Yo, the Science of Flipping podcast listeners, what is happening? I am back with an incredible guest today. This is a longtime real estate investor, someone who understands how to raise money, understands how money works, and how to properly invest their money and your money. Mr. Chris Miles is in the house. What's up, brother?
What's up, Justin? Good to be back on. Well, back with you again on a different show.
That's right. And so you've retired twice since so far in your life, and you did that all before you were the age of 40. Let's quickly talk about that journey so people understand, like, you can retire if you understand how money works, if you use money the right way, if you have the right business model, but then also, what are you going to do after you retire, right? So talk a little bit about that journey.
Yeah, when I was raised by my parents, I even spent 5 years in a trailer park, I was raised by very middle-class parents, but they always felt like they were broke. We can't afford this. What do you think money is? What do you think I am made of money? Money doesn't grow on trees. My favorite one was my dad when he said, you know what, Chris, I want to have kids, or, I wanted to have kids, and because I prioritized that, I got rid of that dream of a Corvette. I was like, well, that's awesome. Thanks for, I'm going to be talking to some hypnotherapists about that when I get older, But, so anyways, money was always a scarce thing. And so I vowed I never wanted to be that way. And so even when I went to college, I realized that it was like it wasn't the entrepreneur way to do it. It was more of an employee mindset. And so I actually dropped out of college with just one class before I got my bachelor's, looking for some career to do, some kind of business to start. And the first one I got into was being a financial advisor. Not knowing it was so easy to get in is because all you have to do is pass a test and not be a criminal, right? Like that's all it takes to be a financial advisor and be an expert in people's lives.
Right.
Well, as time went on, I remember sitting down with my dad, and I remember for the first time seeing his finances, and he'd paid off all of his debt. This guy was like Dave Ramsey's older brother that Dave Ramsey looked up to and said, I should teach this guy, so he paid off all of his debt, including his house, in 18 years. He ended up stuffing money in his 401k, everything good boys and good girls should be doing, right? Well, as I looked at his money, I said, Dad, you're 61 years old. If you want to retire today, you better hope you die in 5 years, because that's when you're going to run out of money. Okay, well, what do I do, Chris? I can't do this anymore. He'd already had, by the way, like heart attacks by his 50s. He had strokes in his 40s. This guy was on his way out. And so I'm like, I don't know. I don't know what to do, because you did everything right from what I teach as a financial advisor. And of course, when the student's ready, the teacher appears. A few weeks later, I called up one of my friends who left my business. I actually trained him to be a financial advisor, but he left to go do something crazy called real estate investing. And I'm talking to him. He's like, so Chris, tell me, how many of your clients are actually financially free where they don't worry about money? I was like, well, they all worry about money. Even the ones that are retired still worry about running out of money in retirement. So none are that free. Okay, Chris, well, how about this? If anybody's got this right, it should be you guys. So how many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these mutual fund investments? And as I was really honest with myself, and I knew a lot of advisors, I said, none. I thought maybe one guy was, but I found out later, once he got fired from that company, he was scrambling trying to find work again. He was just all, they say in Texas, all hat and no cattle, right?
Yeah.
And so I found out pretty quickly. I'm like, well, none of these guys are free. He's like, there's your problem, Chris. I said, all right, I'm open, but what should I do? And he's like, Chris, you just got done arguing with me that stocks were better than real estate. You're not open. I'm like, no, honestly, you've got me here. You've got me to admit I'm wrong. Give me something. He's like, all right, Chris, if you're serious, go get this book called Who Took My Money by Robert Kiyosaki. It's a lesser known Rich Dad, Poor Dad book, which if I was to sum up the 3-hour audiobook for you, mutual funds suck. Okay.
Got it.
There, you read the book. And then he says, now listen to this AM talk radio show, because this is pre-podcast era. This is like 2005, 2006. He's like, go listen to this radio show with these two real estate investors. And so I started listening to it. And what shocked me is they didn't even have time to talk about real estate. They talked about founding fathers and principles and, principles of wealth and creation, all that kind of stuff. Right. And I'm like, okay, I'm eating it up. Well, I went to a seminar that one of these real estate guys put on, and they start ripping to shreds the financial advisor, right? To the point where by the end of that night, I said, I got to quit. I'm out. No more financial advising for me. I'm just going to go teach ballroom dancing and do mortgages, because mortgages was an easy business in 2006. And I was also a ballroom dancer at that time. So I thought maybe I would just teach that at the local university.
Yeah.
Well, any case, but the thing that drove me nuts, even though I quit doing that, I just knew that there's guys in their 20s and 30s that these guys were like real estate flippers that were like making killer money.
Yeah.
I'm like, I got to know how these guys are doing it, because it seems like whatever they're doing is magical, right? Because my little financial advisor brain, even after 4 years of doing that business, was like, oh no, you accumulate a bunch of money and then you live off it like a little starving squirrel, right?
Yeah.
You just save up those nuts and then you live off of them. Hopefully the winter, you outlive the winter or whatever, Well, that was the problem, is that I couldn't fathom. But when they start telling me about like hard money lending, and you could get paid. Now at that time, there were some guys paying like 2 or 3% a month. It was insanely rich, the hard money lending back then.
Yeah.
Needless to say, it wasn't hard to get out of the rat race when you're getting paid, 2 or 3% a month on your hard money, that you're lending out to investors and whatnot.
So you started lending. That was kind of your intro.
It was
gentle. And by the way, guess who always wins? The banks. So I love that was, you like started with the cream of the crop, but that was your kind of softer way of entering versus dealing with contractors and rehabs and all that other noise.
That's right. Yeah. Like I took my very first starter home and I turned that into a rental. Funny enough, it was like my first official flip that I then got back again. So I end up selling it to an investor at full appraised value, stripped out all my equity, and then turned around and leased it from the owner, the investor, and then subleased it out to a renter. And so that was
I love that creative. That was way before people were thinking about creative financing. I love how you think, bro.
Yeah, that was my first deal. Funny enough, other than buying my own house, right?
Yeah.
So I couldn't start easy, but
no.
But like I thought it was fun. I even started doing stuff that now people would refer to as wholesaling. I started doing that with friends and stuff. I'm like, hey, you could sell this property off, get a credit partner, and then of course go and get all the equity out and rent it back, the house that they're living in. So we're doing things like that, a little bit of creative finance stuff. But then of course, I got to that point where eventually between those things and other streams of income I'm getting in, I'm like, I don't even have to work anymore, right? I only need at that time, I only need $3,500 a month to live, because I only had 2 kids. Now I have 8, between a blended family, between 2 marriages. We're like the Brady Bunch, but we had to fire Alice because there's no room for her.
There you go. There you go.
So anyways, so basically I was at the point where I was out of the rat race. I was 28 years old, not sure what to do with my life, But I'll tell you, like, one thing that's interesting is that, I got to the point where, of course, the recession kicked my butt. I mentioned this on one of your other shows. Like, I seriously went from millionaire to upside down millionaire to the next recession, because I got lazy. I was so drunk on all the money coming in. I was like, well, I'll buy my little big mansion. I'll go and I'll throw money at this or that. I started a brand new business trying to teach people how to get out of the rat race. We're teaching flippers, actually, how to get themselves out of the rat race.
Yeah.
And funny enough, they all went broke in 2007. So our whole business model was like just going down the tube fast.
Sure.
To the point where I went, like I said, I was like financially free, to all of a sudden now over $1 million in debt with no money, no credit. I didn't have any confidence to borrow money from anybody anymore, because I'd already lost some of my family and friends' money at this point. So I was kind of in a hard place. And I took a little pivot in my business. I eventually actually started teaching people how to get out of the rat race. Not they really get out of the rat race per se, but instead of doing it with investing, do it by freeing up cash flow, like being a wiser steward of your money. So things like, how do you actually start tracking your money and being a wise steward with that? What are creative ways to pay debt? Because that's what I was doing. A lot of people ask me, like, how'd you pay off over $1 million in debt when you were flat broke? Because I didn't go bankrupt, so I didn't wipe it out. I said, well, I used like this strategy called cash flow index that I created, which is basically what's the highest ROI loan that I could pay off, right? Like, which one, if I invest X amount of dollars to pay off that loan, will give me X amount of dollars of cash flow. What's the highest ROI, right? I was looking at it from that standpoint versus interest rates and stuff.
That's right.
So anyways, I know that's not the whole focus of this episode, but long story short, I was able to eventually dig out of the debt hole. I actually built a whole business model. Even companies like Wealth Factory started using my stuff, that I let them use after I launched and did money ripples. And it was awesome. Like, I got myself to the point where I was able to get out of the rat race the second time, by the end of 2016. It was actually December of 2016. I was like, I did the math. I'm like, I'm out. I have enough passive
income. And when you
now
find out, and this is one thing I think all of you out there, real estate investors, you have to understand, when your monthly expenses are covered by your passive income, you no longer have to work, right? And you found a way to do that twice effectively. Now, economic things happened where you got caught, right? And you had to go back into the game, and then you were able to recreate it. And so I think that's a very common thing, by the way, for most entrepreneurs, if you're out there, is there are seasons and you are king of the mountain during one season, and then you are, just a commoner trying to fight your fight each and every day. And that is normal. Anyone who I've ever seen at any level, anyone I've interviewed here on these podcasts that have, extreme success has gone through those peaks and valleys. So that's right. Common for all of you out there listening to it. So you've been able to now twice be able to create enough passive income to effectively choose to work or not.
That's right. Exactly. Like I don't have to do, I honestly, like, even though I have the company Money Ripples, I could shut it down today. My whole team knows it. I just know that I'm passionate enough that I got to do something, because I can't just sit around and do nothing, right? Especially because I feel like I was given this God-given opportunity to actually do something better with my life to help others too, and create that ripple effect through people's lives. Hence the name Money Ripples. Money Ripples.
Right? And that's a podcast that everyone should be going and listening to. Money Ripples on Apple, moneyripples.com. Everyone should be going and seeing Money Ripples, checking it out, listening to more, Chris. Keep going, brother.
That's right. And just kind of as a bonus for you guys, if there's anything I learned from going broke and getting out of the rat race twice, I'll tell you this, is that if I were to start over again, one thing I would do is I would remember these three things: is get lean, get liquid, and get out. Right? Get lean is just like, and I saw a lot of guys in the real estate space, especially because I'm in masterminds with a lot of flippers and wholesalers and such. And the ones that were really living a little fat and happy, both personally and in their business too, they're the ones that had to pivot the most and pretty much were out of business as well. So, so get lean. Don't have to be cheap. You don't have to live on rice and beans, cut out your latte, all that stuff. You can still enjoy life, but just be a wise steward of your money. Make sure you're tracking it and watching it like every week. Business and personal.
And as an investor yourself, and then being in these masterminds with myself and others, like, they're not doing that. 99% of these investors flipping homes, wholesaling, they are not tracking their money, probably even quarterly, let alone every single week. Let's just talk about that. Let's pivot the conversation a little bit. Yeah. What do you advise all those, wholesalers, fix and flippers that are creating a bunch of this active income? They potentially are living high on the hog or not, whatever. What's some advice that you can give these individuals that's helped you create enough passive income, right? The idea is, I want everyone to realize fixing, flipping, and wholesaling is great. I love it. I still do it today. It's active income though. But I also have bought 3 different apartments so far this year. I've bought, 28 single family doors. Like, I'm doing both. What I want to hear from you is, what do you recommend to everyone out there that is actively flipping and wholesaling, creating the active income? How can they think more like you?
Yeah, you gotta think like, can I survive even if this business is shut down today, right? If all of a sudden, like, the government comes out and says, you know what, you can't do your business anymore, you're done. Like, can you quit today? And if not, then you got to start building towards that. That's why you got to get lean, right? You got to start tracking your money. If something does change, you need to know exactly what your burn rate is. What are your expenses? Like, every single week, you got to know that kind of stuff, right? You got to know how much money is actually coming in or supposed to be coming in, watch it. It's like, it's really a natural law of the universe, if you really think about it, right? It's that law of attention. Whatever you put your attention towards will expand and grow, but whatever you ignore will leave you. That's like the law of atrophy, right? Because, for example, if I don't brush my teeth, if I ignore my teeth, I won't have teeth anymore. If I ignore my spouse, I won't have a spouse anymore. You ignore your kids, you probably won't have kids anymore, right? And if you ignore your money, it won't be there either. It'll leave you just like everything else will. And so you got to make sure you're watching it. And that kind of goes along with that get liquid. That's essential. The one problem in the financial world is that they teach you to lock your money up in prison. Lock it up in IRAs and 401ks, even if it's Roths and stuff like that. They tell you to lock it up in your house equity, and I'm not opposed to people if they want to pay off their house. If that's the case, awesome. But I would not do that unless I had so much extra cash that I couldn't even do anything with it, right? Because the mistake I made in the last recession, in the Great Recession back in 2008, was I threw in extra money in my house because I was a mortgage broker. I figured if I ever needed cash, I'll just get a cash out refi and have it done. But you know what happened? I even threw in more money. I actually finished off a basement in the new McMansion I bought, threw a bunch of money into that. I had now $150,000 equity. When I went to the bank in July of 2007, they said, oh, you know what? We just changed some rules. Get your credit score up 2 points, and then in August, you can refi. So I got it up over 2 points, just like they said. August, I said, here I am. You see the credit score? It's good. They're like, it is. Good job. Well, we just changed some new rules. Now you need to do X, Y, and Z, jump through these hoops, and then we'll give it to you in September. I did all that. I go back in September, and they said, sorry, we don't give any more loans to investors or business owners.
If aliens abducted you, would they be impressed or disappointed by the leads in your CRM? Over 850 real estate investors are currently tapping into the goldmine of motivated seller leads from property leads. Guess what? They're not just twiddling their thumbs. They're closing deals left, right, and center. And their conversion rates are anywhere from 1 in 8 to 1 in 15 leads. Property leads are the masters of delivering top-tier inbound leads, think SEO and PPC, the kind that make your competition green with envy. And did I mention, they refund any spammy leads. Talk about a risk-free investment. The best part? You don't have to lift a finger. Every lead is immediately zapped straight into your CRM, phone, or email, and there are no missed opportunities. Why settle for lukewarm leads when you could be igniting your real estate success with property leads? Time to add some serious fuel to your fire. Head over to propertyleads.com/flip, FLIP, to unlock exclusive access to motivated seller leads in your markets. Just 5 minutes to set up your account. There's no excuse to delay. That's propertyleads.com/flip, FLIP.
Yeah, so when I had that property that they wouldn't let me cash out refinance anymore, that money was trapped. And of course, the rest is history. The markets tanked and all the equity disappeared, which is why eventually I foreclosed on that property. I tried to short sell it, but it was owned by Lehman Brothers, and they didn't want to short sell. So eventually I did get a $300 settlement for fraudulent mortgage practices from that company. But that's the thing, is like, it was trapped in there. I would have been better off weathering that storm had I had that cash in hand, not sitting in equity in my mortgage, right, in my house. Yep. So that's the big thing about getting liquid, is get your money out of prison, get it liquid, get it available to use. And it might be more than you think, especially if you're in real estate. I mean, I remember talking about this with Steve Trang. If you guys ever, follow his stuff, we were talking on his show before. And I remember he's like, well, how much should they have? I was like, well, at least 6 to 12 months of your expenses. But if you're in business and you're paying for marketing and stuff, I mean, if you're just flipping, that's one thing. But if you have a business where you do a lot of marketing as well, it might take 9 months for that marketing to work. You might need 12 months of expenses just sitting on the sidelines. You might hate because you feel like it's not doing anything, but it's essential. Anybody who's made a lot of wealth has learned you've got to have a good chunk of money on the sidelines that's not being invested, because you've got to have it there just in case. And the person with that money is the person that's going to control the terms. That's the person that's going to win no matter what.
So do you think they should be like quite literally holding it, or do you think they should be utilizing it, lending it, investing it at higher returns in a safe way? What do you think they should be doing with that money?
For the most part, holding it, right? I mean, maybe short-term stuff can work, but even short-term lending, even if it's gone for like 6 to 8 months, it may not come back if it gets caught up in some crap, So I like to keep it liquid. And here's what I do, right? So, I mean, the last year has been funny because we've had like banks like Signature Bank and whatnot, where they've had some failures, and then all of a sudden it just stopped. Like, and there's been a random few bank failures here and there, but they don't really talk about it. I don't trust banks, honestly. So you can store money in the bank. And in fact, I was a member. We were at a mastermind group together. This is last year when we were at this mastermind, and we were having a breakout meeting, and someone was asking, it was actually one of my clients. He's like, well, where do we hold all of our cash? Because Chase Bank is treating me like crap right now. I've got millions with them. And apparently that's not enough for them to treat me right.
Right.
And it's like, I said, Ron, like, listen, you already know the answer to this. You already know, because what you've already got money sitting over here doing like, what we call a strategy called infinite banking, right? It's like you already got money sitting over here earning better than the bank. It's tax-free and it's protected from losses and creditors. You already got money here. Just get your money away from the freaking bank. And so even in my situation, like I have a little bit of money in the bank, of course, for quick, easy transactions, but I keep the bulk of my savings in a place where it's tax-free, protected from lawsuits and creditors, and I'm making more than 0.nothing% like my bank pays me right now. And I'm making like 5 to 6% a year tax-free, just letting it sit there.
And because I have one of these policies, I would tell all investors, you guys really got to listen up, right? If you're a real estate investor, it's because you want to have your money work for you while you're sleeping, essentially. 5 or 6% may not sound sexy to you. What can be sexy is the opportunity to borrow from it, lend it out, create arbitrage, and repay yourself tax-free, right? Talk to the investors about that, right? You're a real estate investor, but you think as a true investor. And what I mean by that is you don't just think about real estate, just like I don't, right? I have multiple, I don't even want to go through the laundry list of investments I make. But, talk to the real estate investors about this concept, because people will make the argument, and you know this because this is your whole business. People will make the argument, yeah, but what if I need the money? So let's talk to that point.
Exactly. I'll tell you. So I first learned about this strategy specifically, like right about, actually it was 2006 when I started learning real estate investing. All these real estate investors telling me about this infinite banking thing, right? And as a financial advisor, I'd never heard about it before. And it was pretty new back then. It wasn't as hot as like it is on YouTube right now. Heck, I put infinite banking in my title, and all of a sudden I get more views on my YouTube video than at my other podcasts, right?
Sure.
But I'll tell you, like I first learned about it, and they referred me to the guy that was doing it for them, and I remember seeing it. And remember, I was insurance licensed too, right? I had been securities licensed, I've been insurance licensed. I knew about life insurance. And so they're showing me this whole life policy that they're saying, hey, you can be your own bank. You can pay yourself back. The whole Nelson Nash Be Your Own Banker book, which is a good, decent read to get an intro to it. But I was like, okay, I read the book and everything, but I'm looking at how you design this policy. And the first 2 years, I'm throwing money in. I have zero cash in that tax-free savings account. Like it's all going to paying for my death benefit. You're making me pay $1,000 a month to get like $1 million death benefit, but I have no cash in here. Not until year 3. And even then, it's just not much. And I said, is there any way I can make it better? His answer was no. If you try to put even a dollar more into this thing, it'll get taxed. Like you'll trigger a bunch of taxes and stuff. So don't do that. Okay, I'll take your word for it. I trusted the guy. He was a friend. I was like, fine. Well, guess what? 2008 hits. I'm in the whole $15,000 a month, right? So I can't afford to pay $1,000 a month. I called the insurance company. I'm like, is there anything I can do? They said, no, you got to pay $1,000 a month or you lose this thing. I paid $25,000 into this freaking infinite banking policy, as they talk about, and it basically got canceled. It was like the most expensive rip-off term I could have ever purchased.
Yeah.
Here's the kicker, though. About several months later, I'm talking with a friend who also bought a policy from the same guy, and he said, you know what I found out? You can actually have cash from day one in there. I was like, are you kidding me? I had asked that guy point blank. He told me no. So I started doing my own research. I started doing my own thing, even running my own numbers with other companies, doing it myself. And when I find out, I could have actually had cash from day one.
Did this guy know, or did he not like you? Like, why would he just not? What was the story there?
So I confronted him about it. And we actually had a 2-hour debate in our office about this thing. In fact, it got so loud and heated that the assistants outside the door could hear us yelling. And I said, and he's like, well, the death benefit's the powerful thing you need to have. I'm like, screw the death benefit. I want cash. I'm an investor, right? And so finally, like, he's like, well, we got to make it apples to apples. So I upped his ante a little bit, right? I was like, fine, I'll match your death benefit, but I'm going to do it this way where I can have cash from day one. And guess what? I beat his numbers. And after I knocked every objection, finally at the end of that 2 hours, he said, Chris, I designed it that way because I could not afford to cut my commissions. There you go.
It's always what's in it for me. I need to make a commission, so I'm going to do whatever I can make the most commission.
Oh, yeah. And this is the guy that would verbally speak. And again, this guy normally would give you the shirt off his back. A good, always about being a value creator. But right there, it's like you are really a professional insurance agent. You're not an investor. You're an insurance agent posing as an investor. right?
Right.
And so I was pissed. I was like, I'm not going to send you a referral again. And that's where I spent really the next 15 years, like finding ways to do it. And I couldn't find anybody to do it consistently. I mean, even the guys out there, you see these infinite banking videos, even when I try to refer my clients to them, they wouldn't consistently do a good job. They wouldn't do the best job where they minimize those fees as low as you can possibly go because they don't want to cut their commissions. And so eventually, like I finally in 2017, I took it under my own roof. I just said, fine, we're going to do it inside of Money Ripples because I can't find anybody else who will do it right. In fact, that's the one thing that kind of got me out of retirement the second time was one, because there was a podcast host that was really begging me to do it. But two is because, honestly, like I couldn't find somebody to do it right. And my business motto is this, or kind of my own little personal mantra is that if I can't be the best in the business, I don't do that business, right? Like, yep. So that's why we only do two things. We do passive income consulting and we do the infinite banking. But I mean, that's why I was so pissed that the industry allows that to happen. And you're right. Sometimes the agents don't know how to do it. That's the vast majority. But those that teach infinite banking, many of them do know how to do it, but they won't do it because it will cut their commissions. Or two, different insurance companies pay different types of commissions. I mean, there are insurance companies that offer to pay me more money than when I'm getting paid for certain insurance companies because, well, they pay more money, but they also charge the client more money too, right? So it's kind of a catch-22. It's like, yeah, okay, you can pay me a higher percentage, but the problem is that the client doesn't get it. And so I always tell those same companies, even companies like Mass Mutual, I'm like, all you have to do is beat these other companies' numbers. I'll write Mass Mutual. I don't give a crap, right? Like, you just give me the best dang thing I can get for an investor where I have more cash from day one. And so when people are worried about infinite banking not having cash available, I know exactly what they're talking about because I was in that same problem back in 2006 through 8, right? Because my money was just going to pay for their insurance costs, which pay their commissions. So
that's right.
When you see people saying, well, we do like a 60-40 blend and stuff like that, it's like, no, that's just it's kind of like a medium point. They're like, well, it's still not the best for the client, but at least it's better than the normal way. So I'm kind of meeting them in the middle. It's like, that's still crap. If you do what's right for somebody, you'll make plenty of money.
Yeah, the reality is why this is so powerful for a real estate investor is because you yourself have been a private money lender. You can, lend into your own fix and flip. You can lend into your own earnest money deposits for wholesaling. You can lend to other people, of course. But, going back to the real estate play, like having something like this that keeps your cash liquid and then you can utilize, so it's not actually ripping from your actual bank account.
That's right.
In the sense of like using all your money. Talk to us about like how a fix and flipper is best going to utilize a policy like this.
Yeah, the best way, I mean, one, I said like storage of cash. If you need that war chest just in case, don't let it stay in the bank where you get, you make maybe 0.0% and you get taxed on 0.0%. And even the high yield savings accounts, they might pay almost the same rate, but you still have to pay taxes on that, right? Mm-hmm. I love the fact that I don't have one more tax form to deal with at the end of the year. I don't know if you guys are the same way, but I hate that I get tax forms from all different sources and I got to send it all to the CPA. I don't have to worry about taxes. It never gets taxed, right? It's kind of like a Roth IRA that way, but I can actually access the money whenever I want, even from day one. So that's one reason I use it. The other way I use it as a real estate investor too is not just having that war chest, but it can be leveraged in different ways too. One, Walt Disney, right? I mean, obviously we know he created the happiest place on earth, apparently. And, it's maybe not more secret.
Maybe not.
It's happiest place on earth when I don't go with my kids sometimes. I'll tell you that much.
There you go.
But it's cool with kids, but at the same time, it's kind of cool being an adult too. But after he did Disneyland, that was a success. And so he started looking at the swamplands of Florida, right? This crappy little swampland area. And he was privately trying to buy it up. And he went to the banks. He said, hey, I want to get a loan so I can go ahead and develop this. I want to create another amusement park. The banker's like, we loved you, but let's be honest, you didn't do the best. I mean, that's a one-time thing. Doing it again on a bigger scale, I'm not so sure about that. And so they gave him the condition to say, if you were to give us some collateral, we'll give you some money. And so he went, this is in his documentaries and books and stuff. He did a cash out refi he got a line of credit against his house. And then he used his life insurance policies, the cash value from his whole life insurance policy as collateral. So they would give him the loan and then the rest is history, right? And even other business owners have done it too. I mean, Pampered Chef, if your wife uses Pampered Chef, that was the seed money for starting it, was using their life insurance policy. McDonald's, Ray Kroc, when he bought out the McDonald's brothers, he was paying the executives from the life insurance policies that he owned. J.C. Penney's during the Great Depression paid their payroll during that period of time and was able to weather that. Now, they couldn't beat 2020. That got them. But they did at least make it through the Great Depression because of it, So it's one of those things. It's a good pool of money, but like I said, it's protected from lawsuits and creditors in most states, 100%. You could have millions of dollars sitting in here, and if you have money in the bank, they can get that money right away if somebody sues you and wins. It doesn't happen here. The cool thing is, if you got kids, you want to get them to college, guess what? That money doesn't count as an asset for college. So if you're trying to get them scholarships and financing, that you could have millions in there and it doesn't count against you if you had like a 529 college savings plan. So many people will use this as a savings plan for that. Even for mortgages, I'll actually use the statement for my life insurance to show that, yes, I've got collateral, I've got money. Another way you can use it too as collateral is I had a client where...
Now, is that only the cash basis or is it the entire policy?
It's the cash, not the death benefit. It's the cash. Yeah. The death benefit...
By the way, let's also talk about that. You actually get death insurance, right? Life insurance, which, for those of married and kids, that can be important. So let's not totally forget there's an actual asset, which is if you pass, your family can be taken care of, right? So let's not overlook that too far.
Definitely not. No, I've had seen that happen time and time again too. But yeah, like even and actually the death benefit does work if you ever get business loans. Like when you do business loans, a lot of times they'll ask some insurance policy like your death benefit. They want to have a claim to that in case you die before you pay off the loan. You can always use that too. So you're not even using the cash, you're using just the death benefit, which is much higher amount than the cash. Another way it's kind of a cool strategy with real estate is I had one client where he had like $300,000 sitting in his cash value of that life insurance account. He's like, Chris, I think I'm just going to cancel it and cash it out. I'm going to cash this money out, and then I'm going to use this to go buy a property for my office building. And he's like, I'm going to get renters and everything. I said, hold on, Sparky, let's slow down here a little bit. Why don't we go to your local bank, your credit union, whoever you have a relationship with, and let's just see if they'll use this as collateral to get a loan. And so he did. He went to the bank. They said, well, yeah, if you got the building and you got this as collateral, we love it. And we'll even give you extra money for the build out. So they gave him more than what he had in cash in the policy because, again, it was a real estate property. But here's the cool thing. The going rate at the time for a commercial loan was about 6%. They gave him a loan at under 4%. It was like 3.75%. So he got this dirt cheap interest rate on the loan, on the mortgage. So his payment was like $1,800 a month for $375,000. He went ahead, built it out, got a renter that was more than paying his mortgage payment. So he was basically officing in his office rent free. A year and a half later, he went back to the bank. He said, listen, it's all done. It's developed. We still have the real estate as collateral. Can we take the lien off my life insurance now? And they said, yeah. And we'll leave the terms the same. Now, if he had just cashed it out, used his cash like every other real estate investor, he would have been paying probably about 6% on his mortgage. But because he used that as collateral, he was able to negotiate it down to 3.75 and keep it there, fixed rate at 3.75. I guarantee he's not changing that mortgage anytime soon, right? So
no. Now, this really interests me because I obviously have this policy and probably even getting more, but he didn't use his cash, or did he use his cash in this scenario?
No, he just used it as collateral. So they locked it up. They made an agreement that he wouldn't use it, right? So they basically became like kind of like a partner in it, in a sense, right? They became like the lien holder on it.
Sure.
So he couldn't access more cash. Now, if the cash grew above and beyond the amount that they designated, which was like $300,000, he could use that extra amount that was growing in there.
Right? At the end of the day, it's doing 4 or 5, 6% in growth.
Exactly. It's growing and compounding. So yeah, you still get access to that extra cash anyways. But yeah, eventually that $300,000 came back and he's able to use it for whatever he wants. And that's the next part that's most confusing for people is you'll hear out there, and I actually teach it too, is that you can double dip, right? You can get your money to pay you twice if you use the strategy versus using a savings account. So for example, most people in real estate space, even for flipping, right? A lot of times if you're using your own money, you're using your own cash, you put it into the deal, and then as it comes back out, you replenish the cash, put it back into your account. Even as your point, Justin, like you and I are doing, like we do rentals as well. if we keep for more long-term, create more passive income so we can be free that way. I mean, even then, you use that cash flow to kind of rebuild that savings account so you can rebuild it to a certain point and then you can reinvest it, right? Mm-hmm. Same thing, but if you use your life insurance, you get an added benefit because just like before, you can withdraw money from your life insurance. You can withdraw it just like a savings account. But here's the problem. When you withdraw money out of a savings account, you lose the ability to earn interest on that money. Yes, you can invest it and you earn money in that investment, but it's not like the savings account's earning interest anymore. If you deplete that savings, you're not earning interest inside the savings account, right? Well, what if you can get a secured line of credit against it? Because you can go to your bank, if you have a savings account in your bank, you can go to the bank and say, can I get a secured line of credit against my savings account? Lock up the money in there so that you don't touch the savings account, but then they give you a line of credit so that you can use that money to invest. Problem is the banks don't give you the greatest of terms, but life insurance companies, they do. Life insurance companies, though, they give you about the same loan rate as about what they're paying you on that money.
Yeah.
So say you have $100,000 sitting in there right now, you want to borrow, let's just say $100,000, even though it's 95% you can access. Let's just say it's $100,000 for easy math. Yeah. You borrow $100,000, you go and use that into your flip, right? And you're doing stuff. Here's the cool thing: when you borrow the money from the insurance company, there is no minimum monthly payment. You pay it back however, whenever you want. The deadline for paying back loans to the insurance company is your death. And they just take it out of your death benefit anyways, right? And then pay the rest of your family tax free.
So if you take, let's just use an example, you have $100,000 there, you borrow $30,000.
Yeah.
For whatever reason. Mm-hmm. You technically don't ever have to pay that back. There's no interest accruing. And if you die, and we all die, so when you die, that's when the $30,000 comes out of the death benefit, which let's just say if you have $1 million in death benefit, then you'll get $970,000 of death benefit. Is that correct?
That's correct, except they do charge you interest. So they do charge you interest. But the reason that they don't really require a payment is because at the same time they're charging you interest, and that's growing, you're also growing and compounding your money and interest over here, right? So usually it's secured and collateralized because they're kind of both growing together. Now, if you did that, I mean, eventually you really don't win. So the only way you can win in that situation, this is where there's a lie out there. People will say, like, there's guys out there will say, you pay yourself back, right? You pay yourself interest. That's BS. You do not pay yourself interest. You are paying the insurance company interest. But the half-truth that they try to weasel you on a little bit is that, yes, the insurance company is paying you interest on the cash that's in that account because, like you said, if you have $100,000, you don't pull any money out. It's still earning interest on that $100,000, even if you borrowed 30, right? So if
you borrow all of it, let's say you rip out all $100,000, are you still earning interest?
Yes, exactly.
Interesting.
So you're still earning interest on $100,000 because you're just getting a line of credit from the insurance company's money that they're giving you. And yes, there are banks that will do it, but right now the bank interest rates aren't as good as the insurance companies currently. But 2 years ago, I was getting bank lines of credit at 3%, while I'm getting paid almost 6% on my money. I mean, do the math; it's pretty freaking awesome.
Right? All day
arbitrage is awesome, and then I'm still investing it and making money on the investment too, right? Yeah. But even if it's the same rate, even if it's like I'm earning 6 and paying 6, that's okay because if I take the cash flow from that investment, say it's paying me $1,000 a month, I'm using that to pay down that line of credit. It's charging me less and less in interest. While on the other side, my $100,000 is compounding more and more interest. It's going like this curve, where the interest is going like this. So you can actually, they're not the same interest. There's compounding interest and there's simple interest. Simple interest is cheaper than compounding interest. That's so right. If you use the cash flow to start paying down that loan, what happens, you start making a spread. You start making more interest over here in your account, and you're still earning all that $1,000 a month on your investment. That's where you get that double dip effect. That's why even somebody says, if they're a passive investor, they're like, hey, I can do a hard money loan and get paid 10% on my money. Well, cool. If you use this strategy, over time, that could be 11, 12, 13% rate of return on your money instead. So you're able to get money paying you in 2 places at once.
Well, right. Why wouldn't someone just borrow from their, let's just use $100,000. You borrow $100,000, you lend it at 10% interest, but then you're still making 1% interest even though the money's gone. 1 to 2% interest, right?
Mm-hmm. That's right.
Your point, right? You're making the 10% from the borrower and you're making 1 to 2% from the insurance policy. You replenish it when the borrower pays you back. Mm-hmm. You have more money than if you wouldn't have, right? Because instead of 6%, you made 10%.
Yeah.
And it's all tax-free, correct?
That's right. Everything's running there tax-free. Now, your investment is still going to get taxed however it gets taxed, but you're a flipper, you're a real estate professional, right? You're basically writing off all that stuff anyways. you're doing that. In fact, if you're a business owner, the cool thing is if you use it for business purposes, you're also writing off the interest that you're paying the insurance company. So it's almost like a triple dip in that sense, because now you're getting even more leverage on that interest that you've been paying.
Are you paying taxes on that 10% that the borrower gave you, or you're just putting that back in the insurance policy?
So if it's just borrow, like hard money lending, if you get whatever the normal taxes are happening, it's going to happen that way. Yeah.
Okay.
Exactly. So, but if I do like a real estate deal and I'm depreciating the asset from the real estate that I bought, right? That, I'm getting all that money with all the tax benefits. So that's the one reason why, you have people out there saying, oh, put your real estate in an IRA. It's like, screw that. No, like I lose the tax benefits. I don't want to do that. I want to get my real estate growing and get all the depreciation, all the tax benefits I can get, 1035 or 1031 exchange and all that kind of stuff. Right.
100%.
But yeah, that's how it really works. Like, and that's the thing, like, if you don't pay back the loans, then yes, it's compounding against you, right? But if you do that whole cycle of putting the payments in to cycle the money, which is what most people are doing, they're trying to get that money to go in, build up, reinvest, and do it over again. Even short term, it works great. I mean, I did it with a guy recently. He was actually a syndicator. He had a deal that I was in that was basically he just needed 3 more months' time to get it sold, but he was out of operating capital. So I said, here, I'll give you $50,000 loan for 3 months. He's going to pay me 15% interest. I'm like, sweet. So he did. Like, 3 months later, returned my capital after he sold the apartment building, got my money back, and I just went and paid back for my life insurance. So I used that life insurance money, that $50,000 from there. Yes, I had interest being charged, but he also paid me interest that more than did that, and I was still earning interest on that money. So I'm making, again, interest in 2 places at once to still offset that interest. So
no doubt.
The reason that flippers like it the most, though, that I've noticed especially, is because the one thing they hate is, especially if you're trying to like do a project, say you're like doing a renovation with us and everything, when you're flipping it, and maybe it takes 6 to 8 months. If you try to use your home equity line of credit, you got to pay on that even if you haven't made a dime. Where with this, they charge you interest, but they're not requiring any monthly payments. So it doesn't kill your cash flow while you're trying to work, right? So even if the project goes long, great, it goes long. Yeah, that's okay.
Listen, Chris, I could literally just sit here and pepper you, but I want the people to get a hold of you because they're going to have very specific questions on their business, their structuring, all that. So we have moneyripples.com. We have Money Ripples podcast. Instagram, is it all Money Ripples?
It is. Everything's Money Ripples.
You guys need to sit down with Chris's team because obviously what you're hearing me ask is what you guys should be asking. I'm already sitting here through this podcast thinking of all the different things that I need to be doing, opening up more policies, etc. Brother, I appreciate you being on the Science of Flipping. All real estate investors need to know this and get a hold of his team. Listen to his podcast, but also get a hold of him. I'm sure he responds on Instagram and all those things and talk about your scenario. A couple big takeaways I need you guys all to understand. You need to understand where your money's at weekly, monthly, quarterly, and yearly. But then you also need to think like an investor, a true investor. How is your money working? It should not just be sitting. It needs to be working. And that's why you want to get a hold of Chris. Brother, I appreciate you. Thank you for coming on.
Same here, Justin. Thanks so much.
All right, y'all. That's it for the Science Flipping this episode. We'll see you on the next one. Peace.